Hey there, let me ask you something. Have you ever looked at your employee's paycheck or even your own and wondered, wait, what exactly am I paying taxes for? You're not alone. I'm Noel. I'm a CPA and tax resolution specialist and one of OnPay's subject matter experts. And today we're tackling a question that trips up a lot of folks. What's the difference between payroll tax and income tax? If you've ever thought they're the same thing, they're not. And knowing the difference can help you make better decisions, avoid surprises, and keep your business running smoothly. Let's start with the one most people have all heard of, income tax. Income tax applies to almost any money you earn, whether you're an individual or a business. That includes your 9-to-5 job, and yes, money from that side hustle you started last year. The government uses this money to fund things we all rely on, such as national defense, public schools and education, roads and bridges, and public transportation. So income tax is basically the government's main source of revenue. Both the federal government and most states collect it, and they decide how to spend it based on their budgets. Now let's talk about payroll tax, and this one's a little different. Payroll tax only applies to wages and salaries people earn from working. It's tied specifically to employment income. And here's what makes payroll tax special. Both employers and employees pay these taxes. If you're a business owner, you're responsible for 1. Withholding the employee's portion from their paychecks. 2. Contributing your own portion as the employer. 3. Making sure it all gets sent to the government accurately and on time. And unlike income tax that funds general government operations, payroll taxes go to very specific programs, Social Security and Medicare. These essential programs help retirees, people with disabilities, and others who need medical care. Let's break down the main differences. First, the purpose. Income tax helps fund general government operations, while payroll tax is specifically designated to fund Social Security and Medicare programs. Second, what's being taxed? Income tax applies to nearly all types of income, including wages, investment earnings, and even rental income. Payroll tax, on the other hand, applies only to employment, wages, and salaries. Third, the tax rates. Income tax follows a progressive system, meaning the more you earn, the higher your tax rate. Payroll tax uses mostly flat rates that stay the same regardless of income, though there are some exceptions we'll cover in a minute. And fourth, responsibility. With income tax, employers assist by withholding taxes from paychecks, but the employee is ultimately responsible for making sure the correct amount is paid. With payroll tax, the employer shares that responsibility equally by both withholding from the employee and contributing their own matching portion. Let's walk through a simple income tax example. Let's say you're single and your taxable income for 2025 is $50,000 after all deductions. The IRS doesn't just take one flat percentage. They use what we call tax brackets. For 2025, you'd pay 10% on your first $11,925, 12% on income between $11,925 and $48,475. 22% on the rest up to $50,000. It's like a staircase. Each dollar gets taxed based on which step it sits on. Now, payroll tax is more straightforward, but still has its own quirks. In 2025, the total FICA tax rate is 15.3% of employment income. 12.4% goes to Social Security, and 2.9% goes to Medicare. But here's where it gets interesting. You don't pay all that yourself. You split it with your employees. You each pay half, which means the employee pays 7.65% from their paycheck. You as the employer match with another 7.65%. There are also some limits. In 2025, the Social Security portion only applies to the first $176,100 of someone's earnings. Anything above that, isn't subject to the 6.2% Social Security portion. Medicare has no such limit. It applies to all employment income. Plus, there's an extra 0.9% Medicare tax for high-income earners making over $200,000. Let's look at an example. Meet Sarah. She's an employee earning $5,000 per month or $60,000 per year. For payroll tax, Sarah pays $310 per month to Social Security. That's 6.2% of $5,000. She pays $72.50 per month to Medicare. That's 1.45% of $5,000. Total payroll tax from Sarah's check, $382.50 per month. As her employer, you match that $382.50, bringing the total payroll tax to $765 per month. Now for income tax, assuming she takes the standard deduction and has no special circumstances, her federal withholding might range from $350 to $450 per month, depending on her W-4 elections. See the difference? The payroll tax calculation is much more straightforward than income tax. As a business owner, here's what you need to remember. For income tax, your job is to withhold the correct amount based on your employee's W-4 and send that money to the IRS. For payroll tax, you're responsible for calculating and withholding the employee's portion, contributing your matching portion, submitting all of it to the government on time, and keeping good records of everything. Just a friendly reminder, the IRS takes payroll taxes very seriously. If you collect these taxes from employees but don't send them to the government, that could land you in big trouble with the IRS fast. Understanding the difference between income tax and payroll tax helps you manage your business finances better, explain paychecks to your employees, and stay ahead of tax obligations all year long. The good news, you don't have to go it alone. Payroll systems like OnPay help automate these calculations for you. You can always partner with a professional to make sure everything's handled correctly. If this video was helpful, don't forget to subscribe for more clear, simple tax tips for your business. Leave your questions in the comments and check out the description below for more helpful resources. Thanks for watching and see you next time.